They told you Social Security increases were modest. They told you the cost of living adjustment barely mattered. They told you to rely on banks, to trust your statements, to assume your monthly benefits were predictable. And yet February is here, and what seniors are discovering is far more important than the routine check-ins and automated deposits. While many are staring at their accounts, wondering if everything is normal, they're missing the hidden dynamics shaping this month's Social Security payments. They're missing the fine print, the policies quietly influencing your finances, the mechanisms banks and institutions aren't explaining. We warned you months ago about inflation volatility. We warned you about shifts in federal calculations. We warned you about Medicare deductions quietly changing. But what is happening now? That isn't just routine adjustments. That isn't simply cost of living increases. That is a structural recalibration, an administrative update layered on top of economic pressures, and a series of decisions that can materially impact what actually lands in your account this February. If you check your statement and saw a difference, even a small one, and didn't understand why, you're not alone. And that's exactly why this update matters. You need to understand the full picture because the banks and even some financial advisors won't break it down for you. Let's start with the timeline. Social Security updates for February are calculated using the annual cost of living adjustment, or COLA. That adjustment is based on the Consumer Price Index for urban wage earners and clerical workers, or CPIW. But here's the subtlety that many seniors overlook. CPIW reflects a weighted basket of goods and services that does not perfectly align with actual senior spending habits. Healthcare, prescription drugs, and energy costs weigh heavily for retirees, yet they are often underrepresented in CPIW calculations. What does that mean? It means the increase you see, sometimes touted as 4.2% or 5.9%, does not necessarily match the real increase in what seniors are paying month to month. Banks will tell you the number they deposited. They won't tell you what that number really represents in terms of purchasing power. And here is the hidden twist for February. Some deductions are front-loaded, some are recalculated annually, and the net payment can vary from month to month in ways you're not expecting. Consider Medicare. While Social Security benefits are grossly calculated based on your COLA, Medicare Part B premiums are automatically deducted before your net deposit. In February, those deductions may shift due to adjustments in federal calculations, late billing corrections, or reconciliations from prior months. That means a senior could see their gross benefit increase by hundreds of dollars, but the net increase after Medicare premiums may be far smaller, or even negative, compared to January. Banks simply show the net amount. They don't break down the recalculation. They don't highlight that your perceived increase may be offset entirely by higher Medicare premiums or new deductions. This is a subtle yet significant factor affecting the real value of February's payment. Another point banks don't discuss: tax withholding. Many seniors set up automatic federal and state tax withholding through Social Security, and those calculations rely on previous earnings and annual updates. The IRS occasionally recalibrates withholding tables in January or February, meaning a senior may experience slightly higher or lower deductions automatically, without realizing that the apparent delay or shortfall in the payment is simply tax recalibration. If you noticed a small discrepancy, it is unlikely a banking error. It is likely an adjustment you weren't made aware of because the information never makes it into standard banking statements. And it's not just deductions. Some seniors are impacted by retroactive payments or corrections. If Social Security identified an underpayment in 2025, your February payment could include retroactive adjustments. The problem? Banks process your net deposit without any detailed explanation of these adjustments. You see the final number, not the breakdown of what portion is COLA, what portion is a correction, and what portion is offset by Medicare or taxes. Understanding this is essential. Otherwise, a senior could look at the account, see less than expected, and panic, thinking their benefits are shrinking or being mismanaged, when in reality, the system is simply applying the updates behind the scenes. Let's dive deeper into the mechanics of COLA itself, because this is where many misconceptions arise. The formula is not arbitrary. It is rigidly tied to the CPIW index as calculated from the third quarter of the previous year. If prices have risen sharply in areas seniors actually spend more, healthcare, prescription drugs, utilities, COLA may still lag behind real inflation. Banks do not explain this lag. They do not highlight that your increase is not a guarantee of increased purchasing power. They merely deposit the number. And for seniors living on fixed incomes, that nuance is critical. Without recognizing this subtle disparity, a routine payment could feel insufficient, even if technically it reflects a legitimate COLA increase. February also brings adjustments for Social Security income limits and earnings tests. For those who continue to work, certain thresholds trigger reduced benefits if your earnings exceed the federal limits. Banks and standard statements do not explicitly flag this. They simply process the adjusted payment. Seniors who are working may see an unexpected reduction in February due to earnings limits being applied retroactively from previous months, yet banks will only show the net deposit. This is another area where transparency is missing and where seniors are left without the insight needed to plan effectively. Now consider the impact of supplemental programs tied to Social Security. Many seniors receive state-based benefits, such as supplemental income or energy assistance, which are pegged to federal Social Security payments. A February recalculation could ripple through these programs, creating slight delays or variations in what seniors receive. Again, banks only deposit the direct Social Security amount. They do not communicate the cascading effects on state benefits. Seniors unaware of this may believe their financial situation is worse than it is, when in fact, these shifts are purely administrative. One of the most underreported factors is timing. February is unique because it follows January, which sometimes includes partial payments or retroactive adjustments from the previous year. Banks tend to process Social Security payments on the second, third, or fourth Wednesday of each month, but any corrections or recalculations can cause a deposit to land slightly earlier or later than expected. Seniors who track payments closely may see what appears to be a discrepancy or missing funds when in fact the adjustment is already in transit or pending administrative clearance. This is critical because perception drives panic. Banks rely on this confusion to maintain the status quo, offering no insight unless directly queried. Furthermore, some seniors are affected by spousal, survivor, or disability benefit recalculations. These benefits are often recalculated annually based on cost of living changes, work history, and eligibility adjustments. In February, recalculations may trigger small variations in payments that banks do not explain, leaving recipients to wonder why the number is different from January. For example, a survivor receiving a combination of benefits might see one portion rise while another portion remains flat or decreases slightly due to a cap or offset. Banks simply deposit the net total. Seniors need to understand these nuances to avoid misinterpreting the results. Another hidden detail: administrative holdbacks and error corrections. Social Security occasionally identifies potential overpayments or underpayments from prior months. To correct these, they may apply a minor adjustment in February's payment. Banks have no incentive to clarify these corrections in the deposit notice. They merely post the final amount. A senior might assume the system is inconsistent or unfair when the reality is that the agency is simply recalibrating for accuracy, and February is the month when these small reconciliations often hit accounts. And let's talk about inflation again. The widely reported headline inflation often does not match the lived experience of seniors. Banks do not convey that the CPIW underweights categories critical to retirees. Here's another layer seniors often overlook: tax year planning. February payments reflect the first full month of the calendar year, meaning withholding calculations for 2026 may be applied for the first time. If your previous withholding was based on outdated tables, the February adjustment may appear higher or lower than expected. Banks do not educate you on this timing effect. They simply post the adjusted amount. Seniors unaware of this shift might misinterpret the payment as either a windfall or a shortfall when it is purely a recalibration of tax obligations. Even banks that offer advisory services rarely provide detailed guidance on optimizing the February Social Security deposit. For example, there are strategies involving voluntary withholding changes, timing of direct deposits versus checks, and understanding Medicare premium changes in context with COLA adjustments. Without this insight, seniors risk losing small but meaningful opportunities to maximize their net income simply because the information is not being proactively shared. Now consider the psychological impact. Many seniors read headlines or consult friends, assuming their benefits are being diminished because the net deposit looks smaller than expected. In reality, it is rarely about reductions in entitlement. It is almost always about adjustments, deductions, timing, or administrative reconciliation. Banks prefer not to address these subtleties because it reduces their liability, and they are not incentivized to educate retirees on the mechanics behind the numbers. This leaves seniors in a constant state of uncertainty, questioning the stability of their monthly income unnecessarily. Let's examine the broader economic context. The Federal Reserve's interest rate policies, inflation trajectory, and fiscal outlook indirectly influence Social Security calculations, particularly through Medicare premiums and taxation rules. Banks don't disclose this. They simply reflect the net impact of policy shifts on the deposit. A senior may see a minor fluctuation in February and assume the change is arbitrary, rather than a direct consequence of broader economic policy and regulatory updates that affect their net benefits. Another critical factor is investment-linked accounts. Seniors who have benefits directly deposited into interest-bearing accounts or linked savings may notice slight differences due to how banks calculate interest accruals, daily compounding, and processing timelines. February often introduces minor calendar effects, 28 days instead of 31, that can subtly impact accrued interest, and these are rarely explained. Without understanding these details, seniors may mistakenly attribute minor fluctuations to errors or policy changes rather than basic calendar mechanics. Seniors should also be aware of automatic payment interactions. Many use Social Security deposits to fund recurring bills, mortgages, or utilities. February's recalculations can create timing mismatches, especially if deductions for insurance, Medicare, or taxes are slightly different than expected. Banks provide no guidance on this, yet the effect is immediate. Seniors may encounter temporary shortfalls or require overdraft protection unnecessarily. One last point banks rarely disclose: cumulative impact. While a February adjustment may appear small, repeated discrepancies, recalibrations, or timing shifts over multiple months can add up to significant differences in disposable income. Understanding that these changes are often systematic, mechanical, and predictable allows seniors to plan effectively rather than reacting emotionally to each month's deposit. So what should seniors do right now? First, carefully compare February's gross and net deposits. Identify each deduction, Medicare, taxes, or corrections, and calculate the true net impact. Second, recognize that banks will not proactively explain these calculations. You must do the work to reconcile the deposit. Third, consider broader economic factors, including inflation, federal policies, and potential future adjustments when evaluating the purchasing power of your benefits. Fourth, consult Social Security's official statements for transparency regarding COLA, retroactive payments, and any recalibrations applied this month. And fifth, maintain perspective. February adjustments are rarely indicative of long-term reductions. They are part of a complex administrative ecosystem that ensures accuracy, compliance, and alignment with federal policy. Here's the bottom line. February's Social Security update is not simply a deposit you see in your account. It is a carefully calculated reflection of inflation, policy, Medicare adjustments, tax withholdings, and administrative reconciliation. Banks will not explain these details. They will show you the final number and leave it at that. Seniors who understand the mechanics, however, gain insight, clarity, and confidence in planning their month. By recognizing the components of the deposit, understanding the timing, and accounting for deductions, seniors can avoid unnecessary panic and make informed decisions about budgeting, bill payments, and discretionary spending. This month, more than ever, transparency matters. Understanding the subtle shifts in February's Social Security payment can protect you from surprises, give you leverage in planning, and prevent you from reacting emotionally to changes that are, in most cases, perfectly normal. The increase, the deductions, the timing, All of it has a rationale rooted in policy, calculation, and federal regulation. The moment seniors recognize this, they regain control. They are no longer at the mercy of bank statements, incomplete explanations, or assumptions about reductions. They are informed, prepared, and empowered to make rational decisions. So, if you have not yet reviewed your February deposit in detail, do it today. Compare gross to net, check Medicare and tax deductions, account for retroactive adjustments, and calculate the real impact on your spending power. Use this understanding to guide your budget, your planning, and your financial decisions for the month. The banks won't tell you these details. The media won't explain them in depth, but you now have the knowledge to see through the confusion and act confidently. February's Social Security update is a reminder that small differences matter, that transparency is rare, and that understanding the mechanics of your benefits is essential. By staying informed, scrutinizing the numbers, and acknowledging the broader economic and administrative context, seniors can avoid unnecessary stress, make better financial decisions, and ensure that their monthly benefits deliver the value they deserve. Knowledge is power. February is here, and the updates are already in motion. Are you ready to take control and see exactly what your benefits truly represent this month? The choice is yours, and the clarity you gain today will pay dividends and peace of mind tomorrow.